Golden investment rule: investment philosophy: ignore rumors and enjoy early mistakes of zinc beard Wall Street. All mistakes should happen at the beginning of life. The more bitter lessons in the coming investment come, the less mistakes we will make later. Michael Steinhardt was born on December 7, 1940 at Mount Kisco, New York. He is a well-known American investor, manager of an outstanding hedge fund, founder of a natural animal protection organization, and also a famous philanthropist on Wall Street. From childhood, right from school, Michael Steinhardt has shown a quality of investment when he regularly goes to the school library and borrowed books on economic and financial books. Shortly after going to college, he spent most of his time learning about stock analysis and often went to stock brokerage offices to sit for hours listening to veteran investors talking and sharing experiences. In 1960, he graduated from Wharton School of Finance. After that, he began his career on Wall Street with a research and analysis position at Calvin Bullitt Mutual Fund Management Company and Low Broads & Company Brokerage Company. In 1967, Steinhardt and two other colleagues were also very popular in the field of investment, Howard Berkowitz and Gerald Fine, establishing hedge fund management company Steinhardt, Fine, Berkowitz & Company, currently based in New York. Under the leadership of Steinhardt, the company is always successful in identifying macroeconomic fluctuations and knowing how to place securities investment strategies in those circumstances. In 1979, the company successfully changed its name with the new name of Steinhardt Partners Fund Management Company. In addition to developing disciplinary principles in basic investment, he also succeeded by working hard on historical data from the financial and mathematical markets applied to the whole market. International office and derivatives market. He has initially achieved outstanding achievements in the field of market trend forecasting. Steinhardt has a long-term investment vision, but most of the investment process he uses short-term strategies. He invests on market-oriented fluctuations, uses a very wide set of securities, and behind him is a team of analysts and investors. He focused on fluctuations in macroeconomic distribution and benefited primarily from it. Steinhardt Partners Stowe, he founded and headed, thanks to careful research in this investment. Customers who were hard-pressed to hear advice from Steinhardt had twice the birth rate of the S&P 500, despite even the most difficult stages of the U.S. stock market. And of course, his investment principle only encapsulates the following 12 basics. 1. Don't believe anyone who points. Don't believe in any business that is good at listening, but don't be disgusted with any company just because of rumors. If you are interested, take the time directly. Real research to make your own views as well as get the right investment decisions. This is the first and crucial principle he shares in Forbes magazine interviewing Michael Steinhardt. 2. All mistakes should happen at the beginning of life. The more bitter lessons in the coming investment come, the less mistakes we will make later. 3. Although the stock code of an enterprise has good fundamentals, however, when the market goes up, the stock will definitely go up, noting that most stocks follow the trend of the market. For example, take a look at the reality in Vietnam to see stocks not only go up in a month or a few, but the stock nature has gone up strongly for many years before it is known and more popular. 4. Do not believe in the company's future drawing, look at the past, and the current specials, look at the financial reports in the past 3-5 years, how it grew, last quarter, and then out why. We need stocks that have been naturally screened. Take advantage of the competition with knowledge. The key to research is to acquire as much knowledge as possible, so that you can become the first person to feel a big change. 5. Technical analysis is very important at the time of purchase. It tells us when big investors need it, when it will reduce supply or demand stimulus. Learning more from technical analysis is the thing never wasted. 6. Investors who cannot control their emotions cannot make money from investment activities. 7. To minimize the risk of bankruptcy of companies, proceed to diversify the stock portfolio to avoid putting eggs in one basket. For him, the ultimate thing is to put all of your capital into a single stock without really knowing the information or thoroughly understanding them. 8. When the whole market is in uptrend, the probability that there will be up to 70% of the stocks will go up according to the market, by when the market is on the way, not by when the market is trying to go down. The probability of winning is very low. 9. Make the right decisions even with incomplete information, because we will never have all the information we need. The problem is how to decide with the limited amount of information we have. 10. Always believe in your intuition, something like a supercomputer hidden in your head. It is something that can help us make the right decisions at the right times if we give it the opportunity. 11. Don't invest small. If you have a serious intention to invest, make sure the reward is attractive enough to deserve the time and effort put into an investment decision. 12. In the world of investment, there is no need to express themselves verbally. Earning money from the stock market assesses the level of success as well as maturity. Say good words and get started right away if we are really passionate.